If you want to never worry about paying rent again, then you should understand how bond laddering works. Bond laddering is a strategy that helps you earn a monthly passive income from your bond portfolio that can actually be used to offset your rent payments or actually replace your monthly active income. In this video, we're going to be talking about the bond ladder strategy. We're going to understand how you can set up a bond ladder from your bond portfolio. We're going to look at what you should look into in setting up a bond ladder and the advantages and disadvantages of bond laddering. Let's start by first understanding what a bond ladder is. So a bond ladder is a portfolio of bonds with different maturity dates. So instead of having one bond that has one maturity date, you can have different bonds with staggered maturity dates. So let's say, for example, you have 10 million to invest. Instead of investing the entire of your 10 million in one bond that matures at one particular moment, you can split your 10 million in, let's say, chunks of 2 million. So you have five different capital amounts that are investing in 5 different bonds that mature in 5 different times. So the good thing with bond laddering is that it helps you manage your cash flows more so if you are a retiree or if you want your passive income to come in each and every month. So remember, bonds pay income. Maybe they pay coupons semi-annually or 2 times per year. So there are people who maybe you want to be paid each and every month of the year because maybe you want to use the bond to offset your rent payment. Maybe you're just someone who wants an extra source of income each and every month to replace your active income, maybe to supplement your active income. So that's the importance of a bond ladder. Instead of investing in one bond that pays 2 payments each and every year, you can invest in different bonds that pay you each and every month or even pay you at different times of every month, depending with how huge your portfolio is or how huge your bond portfolio is and how many bonds that you own. How do you create a bond ladder? So there are 3 main factors that determine how you create your bond ladder. And when I'm discussing this, I want you to visualize how a ladder is. So a ladder has 3 main things. So of course, we have the height of the ladder. So we are going to be looking at the height of our ladder that we're going to use in creating our bond ladder. Then we have the ranks. So the ranks are this. You can imagine the ranks to be the steps of this ladder. And then we have the spacing between the ranks. So we have a certain distance, which is the spacing between the ranks in the ladder, will be the steps in the ladder. The second factor after ranks that you have to look into whenever you're building your bond ladder is what you call the spacing. So the spacing, some investors actually pay attention into the spacing because CBK doesn't float bonds every day, they only float bonds every month. If you look at the maturities of these bonds, they don't have any equi-spacing, and sometimes finding bonds that can actually fit to your bond ladder from the primary market by CBK can be hard. So some people may have to tap into the secondary market and some people don't actually want to tap into that. But essentially, the spacing just tells you the difference in maturities between the bonds that you have in your bond ladder. Then the third thing is the height of the ladder. So for the height of the ladder, you want to look at which bond has the longest maturity date or maybe has the latest maturity date. So for example, if you have 5 bonds, one matures in 2 years, other one in 4 years, other one in 5 years, other one in 10 years, other one in 15 years, that means the height of your ladder is 15 years because the latest maturity date of your bond is in 15 years. So that's the height of the ladder. So some people tend to want to keep the height of the ladder maybe shorter, maybe until a maturity of 10 years. Others want to keep it longer until maybe a maturity of 30 or maybe 25, or maybe the longest tenure they can find, depending with whatever maybe you are thinking about bonds, if you believe in the Kenyan government for such a long period of time. But ideally, a height ladder of maybe 10, 15 or even 20 years can be good. Then you can have the spacings of the bond either in 5, 4, 3 or maybe even 2 years, depending with how many ranks you have in your bond ladder. Next, I'm going to give you an example of how bond laddering works using hypothetical example, because maybe the bonds that I'm going to be sharing here, maybe you can't get the same bonds on the CBK portal or maybe on the secondary market. So maybe you may have to do some adjustments. So for example, let's take an investor who wants to invest 12 million in a bond. So instead of buying one bond and investing the entire 12 million, you can actually build a bond ladder. So you can build a bond ladder whereby you divide this into 6 ranks, maybe into 6 bonds. Each bond you invest 2 million. So you're going to invest your 12 million in 6 bonds, with each bond having a minimum an investment amount of 2 million. You are going to space these bonds differently. So you're going to choose bonds with different maturities. So that's number one, different maturities. So maybe bonds that have, you can decide how your height of the ladder again and the bonds that are going to incorporate, but then just choose bonds that have different characteristics in terms of maturity date, in terms of the interest payment months, because remember, you want to get paid each and every month of the year because we are picking 6 bonds that pay twice per year. So you want bonds that pay you each and every month of the year. And to get that, you have to look at the bond prospectus, because it's in the bond prospectus whereby we get when a bond actually pays its coupon. So have different bonds with different characteristics, being the difference in maturity dates and difference in the coupon payment dates. Have 6 bonds, each 2 million. So assuming an investment amount of 12 million, whereby you are investing your money in 6 bonds, in a series of 6 bonds. So instead of investing your money in one bond that pays coupon in two times times per year. You're investing in 6 bonds that pay you 2 times per year, so you're going to have 12 coupon payments. So how does the math look like? So we are going to assume a coupon rate of 12% per annum. Obviously this can be maybe slightly lower because of the depending with the interest rate environment, but maybe 12% is a very conservative rate because long-term T-bonds can give you anywhere between 13 or maybe 14%, but let's just use 12% as our net return. So after taxes, or even if you have invested in infrastructure bonds which are tax-free, so let's just work with a 12% conservative rate. That's a net return as well. So assuming a 12% return on all your 6 bonds, so obviously they're going to have different coupon rates, but assuming an average coupon rate of 12% on your 12 million, so you have 2 million on each bond. So that means your overall bond portfolio will be giving you an income of 1.4 million per year, and then each and every month your portfolio is going to be giving you 120,000 per month. So that means each and every 2 million you've invested is going to be giving you 240,000 per year, and then if you divide by 2, that comes to 120,000. So that means each and every month you're going to get an income of 120,000 from your 12 million invested in bonds. Now that's an example of how you can set up a bond ladder. So you can use different amounts, different spacings, different ranks, and different heights of your ladder, but basically that's how you set up a bond ladder. So what are the advantages of a bond laddering? So the first example, which I think it's an obvious one, it gives you the ability to manage your cash flow needs. So if you are a retiree who wants a passive income each and every month, so instead of being paid 2 months per year, maybe having to wait 6 months for the next payment, you can actually split your bonds into your bond portfolio into a series of bonds, so that you can get paid each and every month. So that helps you manage your cash flow requirements. Then number 2 is that it helps you to manage what we call interest rate risk, or maybe the difference in yields, because if you look at last year in 2024, we saw bonds pay very high returns, high as 18.5%, 17.9%, and those were actually infrastructure bonds. So guys who had over invested in bonds a few years ago were actually crying in the market because they don't have liquidity or money to invest in these high rate or maybe high yield bonds, and that can happen any particular moment in time, depending on how credit cycles move and how the risk levels move as well. So just to protect yourselves from fluctuating yields and interest rates, you can always spread your bond portfolio over different years, so that you can always have capital or maybe liquidity to take opportunity, or maybe to cash in whenever we have very good bonds in the market. So to avoid that, that's why bond laddering is important, because now if those guys were doing bond laddering, they could have had a bond maturing maybe this year, maybe they could have been able to spread their bond portfolio so that they have money to invest in these new bonds that had high interest rates. Then maybe the last point is also to maybe manage inflation risk, because in most times whenever the inflation rate is high, investors also demand for high rates, maybe for high coupon rates, or maybe for high yields from bonds. So during times of high inflation rates, it's also very good to also invest in high returning bonds. That's why the bond ladder gives you the liquidity, like gives you a maturing bond in maybe that period when you have high inflation, so that you can have money, maybe liquidity to invest in these new bonds that have high interest rates during high inflation times. It has few disadvantages in that in sometimes you may find yourself investing in both high yielding bonds and low yielding bonds. So like what I've mentioned, guys now who are entering to the bond market right now, we are seeing yields coming down. So there's maybe a wise investor who invested all their money or maybe all their savings they had in the infrastructure bonds of 18.5% and 17.9%. So they have a very high yielding portfolio in terms of coupon payments. But for someone who's starting at that time, so if they are still building their bond ladder and they never invested all their money in those two high returning FBs, so now they are actually investing in low yielding or maybe low returning bonds in terms of coupon rates. So that can take the overall return rate or maybe the average coupon rate of your bond portfolio down, because you're actually taking the average of all the average interest rates that the bonds in your bond portfolio have. So that's it on bond laddering. So if you have been wondering how you can actually get to pay rent from your bond portfolio, maybe never worry about rent again, you can always use the bond ladder, invest a certain amount of money that can generate a passive income of that's equivalent to your monthly rent or maybe your annual rent, and then just offset it with your bond portfolio. And as well, if you want to you are a retiree, maybe someone who has a passive income that's a monthly passive income that can easily be achievable through treasury bonds, because treasury bonds have very predictable returns, because once you get in a treasury bond at 12% per annum, you are sure of that return until the maturity of that bond. Then again, bonds as well are low risk instruments. That means that you can hardly lose your money in bonds. Yes, you have seen maybe the risk elevate mostly with the government of Kenya because of our high debt levels. But since our independence, we have never defaulted on any debt obligations. So whether that's going to change or not, maybe that's debatable, but so far we've never defaulted on any debt, and maybe government bonds remain to be low risk investments. So that's it on bond laddering. That's how you actually get to maybe be more organized with your bond portfolio, get a passive monthly cash flow from your bond portfolio. So if you have any other questions on investing in bonds or bond laddering, if you have learned something, let me know in the comments, and see you in the next one.